What's up, everyone? Taxes and Retirement Live. It's been a minute, huh? It's been, I don't know, a handful of months since I last did one of these. A little rusty. I may get the procedure and the process a little goofed, but otherwise, I'm looking forward to this. Got a super good topic. I forgot this already. Andy Panko. I'm the guy who hosts these and is the moderator / founder of this Taxes and Retirement group, through which you are all watching this video now. We got a special guest today, going to be talking about a super informative and valuable topic for those that it pertains to, namely small business owners. Without further ado, I bring you Sean Mullaney. He is a financial planner at Mullaney Financial Tax in Woodland Hills, California. Hey, Sean.
Andy, thanks so much for having me. Really looking forward to this conversation.
Yeah, likewise. And you know solo 401ks well because you literally wrote the book on solo 401ks. Sean, for those of you who don't know yet, I announced this in the group, but Sean recently just published a book called The Solopreneur's Retirement Account, Solo 401k. I may have had that flow messed up, but you can get it on Amazon. I mean, I'll post a link after the fact. Anywhere else people could go to get this or should know about this book, Sean? Amazon's good. Okay, cool. Before we actually get into things, let me just hit you all with a disclaimer. As always, this video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which neither Sean nor I are. We are just two folks here today talking about solo 401k plans. This is only general hints and education. Sean, so a little more about yourself, what you do in your firm and your background.
Yeah, so my name is Sean Mullaney. I'm a financial planner based in Woodland Hills, which is part of Los Angeles, California. I have a solo practice, and I'm actually a career changer. So my first career was mostly in corporate tax. There was Big Four accounting. There was some time at the Internal Revenue Service. And I always had the itch to get into personal finance, and eventually I scratched, right? So in 2018, I left my job at a Big Four accounting firm. And in 2019, I started my registered investment advisor firm. And I like to say with the solo 401k, I'm both a pusher and a user, right? So it's reflective of my own journey, right? So I worked at a large employer and they had a 401k and it was great, right? HR sends you this email, hey, sign up for the 401k, make your investment allocation election, make your contribution level election. And it's great. And you can build up tax advantage wealth, get tax deductions. But when you're on your own, you're a small business person, guess what? Nobody from HR emails you about, hey, here's a solo 401k. So you got to go out on your own and do it. And I did that myself. And the nice thing is with the additional, there's some additional complexity, but there's also a lot of additional opportunity. We'll talk about contribution limits and those sorts of things. So you look, in this transition from W-2 work to being self-employed, there's some daunting things. Part of it with the retirement savings, my theory is it shouldn't be daunting, right? Do we have to do some research? Do we have to get some education? Absolutely. I hope for many out there, my book is a resource on that in that regard, but it shouldn't be, hey, I can't become self-employed because I can't save for my own retirement.
Right. Yeah, that's a great point. And I forgot, someone posted, let's hear the dad joke. That's how out of shape I am with this. So I forgot I usually do dad jokes. So I had some lined up that I forgot to say. One is when I signed up, or when I got my first job out of college, my boss said you should sign up for the 401k. And I said, I can't run that far. I'm sure you've heard that one before. And then last week, my wife said to me, you haven't heard a thing I said, have you? And I thought that's a weird way to start a conversation. No? Yeah, because I wasn't actually listening to what she said. And finally, I was walking down the street and a wizard came up to me. Yeah, a wizard. And he asked me if I can proofread one of his scrolls. It was actually more of a spell check, though. You got it, right? Okay. Yeah, man, those are so bad. Okay, so with the dad jokes now out of the way, thank you for whoever this was that reminded me. Let us get into the topic of solo 401ks. And I don't know, however you want to start with this, Sean. I mean, maybe just give a background, what they are, how they're different from normal 401ks.
Yeah. So there. I actually like to start with the large employer 401k because I think there's a lot more familiarity around that, right? Yeah. So you think about it, you work for a large employer, they have a 401k. Now, the investments in there are whatever the employer provides, right? There's a menu, maybe 20, 30 investments. You need to pick from those. In terms of contribution level, there's two things that are going on. One is the employee contribution, generally limited 2022, 20,500, 27,000 if we're 50 or older. And then there's going to be an employer contribution in most cases, not always, but in most cases, there's some sort of employer match or other contribution. And that's limited mostly by the employer, right? So the employer is not in the business of giving away all their profits to their employees, but there is this idea of, hey, we're going to compensate our employees through a tax advantage retirement account. So there is some employer contribution. Really quick example on that. Let's say your salary is $100,000 W-2 job. And the employer says, you know what, we'll match the first 6% of salary at a 50% rate, right? So always dangerous doing math live, but let's try, right? $100,000 salary, 6% is $6,000. If you put $6,000 as an employee into the 401k, employer says, we'll match 50 cents on the dollar, $3,000 as an employer contribution. That's great, by the way. That's an instantaneous return. We're building up tax advantage wealth. We don't pay tax on that today. Fantastic. Now let's think about a solo 401k. A solo 401k is the 401k for the solopreneur. And that employee contribution we talked about initially, that 20,500, 27,000 if we're 50 or older, that remains the same, right? That's actually no different. But what changes is potentially that employer contribution, right? Because we're not limited to that $3,000 like our old large employer said. We can do whatever the IRS limit is. And in that case, it's roughly 18.
Yeah, I think you froze up a little bit, Sean. Let's hope things come back. Hopefully you all are still, see me. Sorry, you back? There you are.
Yeah, you know what, Andy, I hate to do something on the fly. Do you mind if I reboot my router real quick?
Yeah, that's fine.
I apologize for that.
I'll do a little soft shoe song and dance here for folks while you come back
All right,
online.
I'll be real quick.
No issues. Yep. So yeah, everyone watching, I'll sort of summarize briefly a solo 401k, and Sean will get more into this when he gets piped back in. Loosely similar, well, I guess very similar in many regards to a traditional 401k you may have through an employer. The difference is it's something you open up if you're a individual, self-employed, aka solopreneur person. As Sean was saying, the contribution limit you can make when you're self-employed, you're both employer and employee at the same time. So with the solo 401k, you can still have the same limits of contribution limits as the employee, which was, what was it, $19,500 this year, I think it was, and then 27, I believe, or 26 if you're 50 or older. You can still contribute that much. Now you have to make that much first. Like you can't only have a side gig making $1,000 in self-employment income and put $20,000+ into your solo 401k. That's not going to fly. At least I'm pretty sure that's not the case. We can confirm with Sean. So you can only contribute up to the amount of your income. But point is the employee contribution amount is the same as it is under normal larger employer plans. The difference is the employer contribution. That the amount you can additionally contribute on top of that 19.5 or 20 something thousand as employee, you can also contribute as employer into this one plan. That will be limited by the amount of your total business income that you have in that venture for the year. I'll leave the nitty gritty details to Sean. There's some math and limits around that. I forget. I can be making this up, but I think like you're limited to 25% of your business income could be contributed as employer. Maybe that's something else. Yeah, I don't even know. I stay away from business planning and business issues because they're that much a very different level of complexity and knowledge. But we'll let Sean speak to that. Right. So Dave Myers, thanks. Here we go. So Dave Myers says the level, I got this wrong. It's $20,500 you can contribute as employee if you're under 50 by the end of 2022, or if you'll be 50 or older by the end of 2022, you can contribute an additional $6,500, which brings it to $27,000. Thank you for that, Dave. Yes, I was stuck on 2021 was $19,500. And it will be going up again, these contribution limits in 2023. Some point within the next month or so, the IRS will be announcing the new contribution limits for these plans and the new tax brackets and everything else about the tax code that changes with inflation. They will announce those things some point in the next next month. Thank you for that. Mark Trapman wants to see me dance. No, Mark, you do not want to see me dance. First, I'll probably pull something in my neck. Secondly, it's a painful sight. It's like watching Elaine in Seinfeld where she does that like thing with the kick. You don't want to see me do that. All right. I see Sean looks to be back. Hold on. Good thing, because I was almost about to dance.
Hey,
Sean,
Andy, I apologize. We got some wireless issues here, but I think we're back. I think we're okay.
Quite all right. So we left off. You were saying that the employee contribution to the solo could be $20,500, $27,000 if you're 50 or older.
Yep.
And then you kind of cut out there.
Yeah, but now we have two advantages I want to speak about with the solo versus the large employer. One is the employer contribution, right? So in my large employer example, it's limited by the large employer. It's $3,000. Well, let's translate that to $100,000 of Schedule C self-employment income. Under the IRS rules, we could do about $18,500 and a little change. And the cool thing about it is it's flexible. So maybe one year our cash flow isn't so great, so we only do $3,000 or $5,000, and then the next year our cash flow is much better, and we do the $18,500. We max out that so we can get a lot more in. And then the other thing that I really like about the solo 401k is the control, right? So the solopreneur says, all right, I'm going to pick the financial institution. I'm going to pick the menu of investments. And I think this very generous contribution limit and this idea of, hey, we're going to be able to control our investments, our fees, the fees, that's something people think about. Well, wait a minute, a 401k is for Apple computers, right? That's not for little me, solopreneur. The fees tend to be actually very modest. Now, of course, the funds themselves, generally speaking, are going to have their own fund fees. But there are some providers that say, okay, just pay the fund fees and we won't even bill you for the rest of for the plan itself. There are some institutions where it's hey, maybe it's $20 a fund for the solo 401k, and maybe if you have enough qualifying assets, we'll just waive that, right? So this is a very manageable, very affordable plan for solopreneurs.
And just stepping back, you mentioned that the employee's contribution you can make is the normal IRS limits of $20,500 or $27,000 with the catch-up. That's limited to the amount of income you have, right? If you have a small
That's exactly
hustle,
right.
Okay.
It's the lesser of self-employment income or those stated limits, right? So for the side hustler, and we can talk about side hustles and coordinating between W-2 401ks, but so that is a governor. And I will say that the greater the income, the more the benefit tends to be. One, because the cash flow tends to be better, and two, the tax deduction tends to be more valuable.
Okay, got it. Okay, so that's a good background. Can you just maybe touch on more? You said you can have control over custodian, control over investments. So when someone has a normal large employer 401k, it is what it is. It's at Vanguard, it's at Fidelity. You don't have a choice. The investment menu, you said, is a few dozen funds typically. The fees are whatever they are. For the solopreneur person who's, if they're not already, will be after today's thing, are interested in this, like where do they start? How do they pick which custodian, which investments, et cetera?
Yeah, that's a great point. So, the internet is a great place to do some research in this regard. And so I would say two things: internet, and then pick up a phone and call someone at the relevant financial institution. Okay. So you're looking for a few different things. One is fees and investment selection, right? That's definitely going to be something that's very important. And I will say most of the IRS pre-approved plans at the larger brokerages, the Vanguards, the Fidelities, the Schwabs, et cetera. And we're not giving you investment advice here, but we're saying, hey, this is what's sort of available out there. Give a fair amount of availability and good selection in terms of funds, right? I've not seen that to be a real problem. So that's one thing, though, to look for. Hey, who's got the funds that I like? Second thing to look for is the characteristics of the plan. So I'll give you a couple examples. One, maybe I want a Roth account in my solo 401k. Very doable, But as of this moment, to my knowledge, both Schwab and Fidelity do not offer the Roth option.
Mhm.
So if the Roth option is something that's important to you, well, then, those particular providers, as wonderful as they may be, not really for you. Another thing to think about is some of the plan rules. So solo 401k is generally speaking for a solopreneur, can be for their spouse who works in that same business.
Okay.
But there are rules that essentially don't allow folks to have other employees. At that point, solo 401k is not really your thing. That said, other employees has different definitions. So at Vanguard, if you have another employee who's not your spouse for 1 hour, for $1 of W-2 income, you can't use their plan. At Fidelity, it depends on how you do the adoption agreement. And what they generally do, generally speaking, right, and look at their plan. But my understanding of their plan is they look at the tax rule and says, well, if you had an employee for 200 hours this year, well, they don't count because they didn't have 1,000 hours of work this year. And in 2024, there's another rule of 500 hours in each of 3 consecutive years. So you can have some part-time employees potentially at some of the institutions and qualify for their solo 401k. But at other institutions such as Vanguard, you have that part-time employee, you don't qualify. So I think when you're looking at which provider, it's things like the investment selection, the fees. Do they have a Roth? If I want a Roth. If I don't want a Roth, I don't care about that. And then it's the contours of the plan in terms of, hey, maybe I have some part-time employees in my operation. How does that integrate with their solo 401k or not?
And I'd like to talk more about the plan. So people go to open a regular brokerage account or even an IRA account. It's really simple. You go to Fidelity, Schwab, TD, E-Trade, wherever. There's a standard 5 to 6 page account opening application, basic info, name, address, social, whatever, if you want to add trusted contacts and things like that. Fairly straightforward. With a solo 401k, there is an investment account component, and there will need to be a similar investment account opening process. But because it's a 401k plan, not just a truly individual investment account, there needs to be a plan. There needs to be a formal document that establishes and creates and spells out the plan, correct?
Yes.
Where do people start with that? I think that's the big thing that people probably lose comfort in when they start trying to do this themselves because they don't even know what it is.
Yeah. So to my mind, then there's sort of 2 paths, right? There's the larger brokerages mostly have what they call Irs Pre-Approved Plans, where essentially what happens is that paperwork is generally speaking generated by the institution itself. And then you have to maybe make some selections there. You have to have a name of the plan. One thing you're going to need that you wouldn't need for, say, a Roth IRA or a taxable brokerage account is you're generally speaking going to need an EIN, right? So that's been my experience. In theory, they could use socials, but my experience is they don't even do that, right? So if you're Schedule C, right, you need to go to the IRS website and get an EIN for your sole proprietorship. You may already have that. It's good practice, right? What if you make payments to vendors that need to be reported on 1099s? You want to use that EIN anyway. If you have an S corporation, you better have an EIN, right? There's no other way of operating, right? So you'll need that EIN. You'll need to name the plan. And then there'll be things like making elections in terms of the contours of the plan. Do we exclude any employees, right? So we might have to do that. If we have part-time employees, well, hey, they're under the 1,000-hour rule, or the new 500-hour rule that's coming out in 2024. So we may have to do that. So that paperwork, my experience has generally speaking, been generated by the brokerage. Now, there are plans that are not pre-approved that, these are generally the self-directed plans. Once you go that route, you are significantly upping the complexity and the risk in terms of compliance, right? So what I mean by that risk is, when you're in a pre-approved plan, you generally have a menu of publicly available investment options. It's really hard to have like self-dealing or I loan to myself or something that the IRS doesn't like. But in a more self-directed plan where there's more specialized assets, there's the more of this potential for, I give a loan to my business partner. Maybe that's a prohibited transaction. Or I do some work on a rental property that's in my solo 401k, and that's a prohibited transaction. There are these things that make the establishment process a little more difficult, certainly not impossible, but much more difficult when we're doing a self-directed account versus one of these pre-approved plans where our menu is mostly going to be mutual funds and publicly traded, but it also means we have less risk in terms of compliance and things like that.
Right. And you had mentioned, and thanks for Mark for bringing this up, we often talk in
Yes.
acronyms. So you mentioned someone needs an EIN, which to open a solo 401k, which stands for Employer Identification Number. Can you just, what is that? Correlate that to Social Security number?
Great point. So businesses sort of have their own Social Security number, and it's called an Employer Identification Number, because the IRS wants to track payments and income and expenses and tax returns. So step one is, if we're just Schedule C, right? Step one is I have a sole proprietorship. I have my, whatever it is, my side hustle, my self-employment business. Generally speaking, what I want to go is I want to go to the IRS website. They have a portal for this. And I want to say, hey, IRS, I have a sole proprietorship. Give me an EIN, just like I'm Apple Computers, right? Just like I'm the biggest company in the world. And that, what happens is they'll ask you some questions about yourself. They're going to ask for your social, right? And they will eventually issue you, it'll be a PDF document. I'm pretty sure you get it in the mail later on too. You get this PDF and it'll have a 9-digit number, right? It'll have 2 numbers, a dash, and then 7 numbers. And now that's your sole proprietorship EIN. Okay, that's great. You put that on your Schedule C every year when you file the tax return for, hey, I made this much money and I had these expenses on my self-employment income. Okay, great. But then there's a second use for it, and it comes in the solo 401k form. What I do is I then take that EIN, and when I go to my financial institution to apply for this solo 401k, they're going to say, who's the sponsor of this thing? And you say, hey, I'm a sole proprietorship. And what's the sponsor's EIN? And that's the number you use there. Okay, that's great. And that is necessary to open that solo 401k. A second step that is required here is a second EIN. Well, wait a minute, why do I need a second EIN? Because the plan itself has this legal fiction. I mean, it's a legal entity, and the IRS wants an EIN for that. So when you name the solo 401k, so you might name it John Smith, importer, exporter, solo 401k or individual 401k, something like that. You have that as the name of the plan on the application, and on the EIN application for an EIN for the plan itself. And then what you do with that EIN is you download it from the IRS, same portal. It's now for a 401k plan, an employee benefits plan, not for a sole proprietorship. And generally speaking, you just keep that in your records. It's not often required. One area, and that's generally what's going to happen, is when you file that 5500 EZ, what you need to do is you need to write the name of that. What do you call it? You need to write the name of the plan on that 5500 EZ. That's the same name that you use in the application and you used on the EIN. So that's an important little point there. And I talk about this stuff in the book.
Sorry, I just got dropped. I'm back. That's weird.
This is
still running.
Yeah, the wild world of Wi-Fi. So I just finished up that EIN point. It's not anything to lose sleep about, but I do talk about it in the book because it's this little nuance that I think sometimes folks miss.
Okay, cool. And I'm sorry, just for my own interest now, you said open up an EIN. So get an EIN for your sole proprietorship, even if you otherwise wouldn't be required to. You'll need it for the 401k, solo 401k, and get an additional EIN for the plan.
For the plan itself, yeah. And basically, Andy, what you do with that is you save it for your records, and the name that you say, hey, this is the John Smith, importer, exporter, solo 401k. That's the name that you put on the application with the financial institution, and it's the name you put on any 5500 EZs you have to file for the solo 401k. There are 2 times you file that form. The 5500 EZ, it's not the end of the world. It's like 3 pages. File with the IRS. You would file that when you close out the solo 401k, and then any year the balance in the solo 401k is over $250,000.
Okay. And is that 250,000 as of December 31st or end of plan year, or is it any point during that year it
Yeah, I
breaks?
believe it's end of plan year. I actually want to go double check myself. That's part of the reason you write a book, so it can serve as a reference. It's one of those things, Andy, when the plan starts getting big, right? And that could
Yeah.
be because you've had success or because you did a roll in. We could talk about that a little bit. Maybe I had an old 401k, I did a roll in into the solo 401k. Then it's like, all right, I know 250's out there. At that point, I start, I'm pretty sure it's end of plan year. But I'd want to double check that, and that's part of the reason I write the book, so I can have a reference for that in the future.
Okay.
And you can always go to the instructions to the 5500 easy as well.
So we have a question about that someone sent in that I guess now may be the right time to bring it up. But let's just step through like a live sort of timeline. So you have a business, you get yourself an employer identification number for your business, you open a solo 401k. Let's assume it's at Fidelity. I'll just randomly pick them. So you establish the plan document. The plan document is what details the rules and governing constituent, policies of the plan, the 401k plan itself. With the plan now in existence, the plan can have an investment account opened for it. In that investment account, again, assuming Fidelity, not one of the self-directed ones you said, which can do some funkier stuff, but traditional stocks, bonds, mutual funds, exchange traded funds, you have this account. It's up, it's funded. You put in, 20 grand a year, let's say for 3 years, I got 60,000 plus or minus gains or losses. Normal course of business. At this point, there's not yet any special filing or IRS annual process you have to do for this plan, correct?
Yeah. So if we're like at $60,000, in terms of IRS compliance, well, a couple of things. One, at the end of at the beginning of the next year, I think it's some good blocking and tackling to revalidate the previous contributions, right? So I have a whole chapter on sort of routine maintenance in the book, and basically like, look, let's just do some testing. Hey, what was our self-employment income? What were the previous made contributions? Any contributions we're going to make that still fit in within the deadlines? Let's validate that, right? That's good compliance. That's just good blocking and tackling.
Okay.
Beyond that, then it's tax return reporting in terms of, hey, I put money into a traditional solo 401k. That better show up on Schedule 1 if it's Schedule C, right? Because I want to take that to tax deduction, right? It's great to put the money in, but if it's a traditional deductible contribution, we want to be real sure we claim that deduction. So we work with our tax return preparer just to make sure, hey, I contributed to this solo 401k last year. Where does this show up, right? Generally speaking, there's a line on Schedule 1 to take that tax deduction if you're Schedule C. If you are an S corporation, you have a W-2, I believe it's box 12 should reflect, I think it's code A, is it? It's D, code D. It's all in the book. Code D is hey, you know what? I put in as an employee, I put the 20,500 or whatever that level is. And then you can also on the 1120S, you take the tax deduction for a pension contribution for any employer contribution.
Got it. Okay. So that's when it's not on. Schedule S corporation means
it's subchapter S corp.
Yeah. Okay. I'm sorry, subchapter S. Yes. I guess while we're on that topic, we started talking about making having it show up on your tax return, et cetera. What are the timelines and deadlines? So, for example, Mark Troutman asks, how much time would one need prior to the end of the year to get a plan set up for the current year, and when must it be funded?
Okay. So, establishment deadline. So if you want to make an employee contribution, the establishment deadline is December 31st. But as a practical matter, you're going to want to act before that for 2 reasons. One, if you're calling the day after Christmas and, hey, I want to set up a solo 401k, even if you have the EIN, not going to happen, right? I don't think most of the financial institutions are going to have that happen. So I'd be moving in early to mid-December at the latest. I think October, that's part of the reason the book came out October 4th. I think October is a great time to be focused on this, right? So mid-October, you're watching taxes and retirement. You're like, oh, solo 401k could apply to me. I'll set it up now. Great, right? So fourth quarter is, you don't want to be doing it in after mid-December, and even really, I would have this done well, in early December. Okay. And the other thing to keep in mind too is the IRS EIN portal has shut down at year end in the past. So if you have that if you have a sole proprietorship, you just started this year, get on that IRS EIN portal sooner rather than later, because they can shut that thing down for maintenance at year end.
Okay.
In terms of funding, the employer contribution is real flexible. Just look at the sponsor, either you or the S corp. What's the tax return filing deadline? And if did you file an extension, it extends that, right? And you don't even have to establish the solo 401k until after year end for that employer contribution. That's a 2019 Secure Act tax law change. But what about the employee contribution? That's where it gets a little funky. Schedule C is you have to do either or both of these things. Schedule C, you either have to fund it by December 31st,
Okay.
employee contribution, or you can do a deferral election. It's this odd requirement that's in the regulation. I didn't write the regulation. I wrote the book, right? So you can elect to yourself, email yourself, save in your permanent tax records. I elect for the 2022 tax year to contribute to the maximum allowed to a traditional 401 solo 401k or my traditional 401k, whatever. And then by the tax return deadline, you have to fund that contribution. So it's either get it in by December 31st or do this election by December 31st and then fund by the tax return deadline, April 15th, if we file an extension that goes out to 10/15.
So even as employee, you can still extend as long as you file that deferral process before December 31st.
It's in the IRS regulation, and it's silly. I hope they change that in the future. But then the other thing, one other point, for that first year, you still have to have the 401k established by December 31st for the employee contribution, not the employer contribution.
Okay.
Secure 2.0, it's Section 321 of Secure 2.0, this passed the House of Representatives, being batted around in the Senate right now, would say for that first year, you don't have to have the plan established by year end. So I'm going to infer that you wouldn't have to make the election either. So if this Secure 2.0 passes, for the first year only, you could establish the solo 401k for the Schedule C person after year end and still get in that employee contribution. I hope they just say, forget the first year. We're just going to make that every year and get rid of this silly election. But that is what it is right now.
Okay. So safest if possible, definitely get it established before the end of the year.
Oh, yeah, 100%. Yeah.
There's no reason not to, right?
That's right.
As far as funding it, that's where it gets prickly, especially if your income level is, you're not sure how much you're going to make, especially net of expenses, right?
And that's part of the reason I say you should have a little procedure in place, work with your tax return preparer, January, February. Hey, do we have an estimate of the Schedule C stuff, income, and can we just sort of validate any contributions? There's a big deadline on excess contributions. It's April 15th. Generally speaking, there's remedial procedures that can be done. Usually, if hey, I thought I had 100,000 of self-employment income and I only had 80,000, or I thought I had 10,000, I only had 5, right? There's remedial procedures that can be put in place. I have a chapter on those, but generally speaking, we need to act by April 15th of the following year to avail ourselves of those in the most efficient way.
Okay. Got it. So hopefully, Mark Troutman, that squares away your questions.
Yep.
So I'd like to come back. We started talking about the 550 EZ. It's a form, IRS form number 5500-EZ. When people have normal brokerage accounts or IRAs, there is no special filing. This is another one of the unique angles about a solo 401k. There is this form you have to file, which we touched on. If you have over 250,000 in the plan, or if you close the plan, this needs to be filed. So we have a question from, I don't know if it's Steph or Stevie, STEPHE Suitor. He asks, how hard is it to file Form 550EZ? Specifically, it's only a couple page form, but the IRS instructions estimated takes 27 hours to complete.
Yeah, so I would say this is not something to lose sleep over, right? You want to do a complete and accurate form, absolutely, but it says 27 hours. I think, and look, I'm not a IRS forms expert, but I think part of the reason it's saying 27 hours is because it's folding in much larger employer plans, right? So the solo 401k, generally speaking, is just, it has limited complexity because there's very limited participation. It's solopreneurs, baby spouses. So hopefully, it's not that complicated. And I think that 27 thing is, they have to, there's some regulation or Administrative Procedures Act or something that basically requires them to estimate that. It's just their estimate. And I think they're pulling in larger employers. So that's upping that number. I think that's what's going on there. Yeah, it's a 3-page form, and it's, there are instructions. You may want to consider having your tax return preparer professionally prepare that as well.
Yeah. And just side note on that. So I've done a couple myself and they weren't terribly complicated, but I can see how if you are Microsoft or Boeing or something, you got thousands of people in your 401k, they have to file a form 5500. It's not the easy version, but it's a 5500. That's going to take hours upon hours every year because of how complex they are, right? So to your point, maybe that's where IRS is getting this estimate from. In your experience, do tax return preparers actually know about this form and file it for clients? I've found that the handful of times I've come across it, they simply don't, unless they focus on small businesses or consider themselves like sort of plan administrators. They don't know what this form is.
Yeah, and that's part of the reason I wrote this book, right? I think there's a lot of knowledge deficits out there, both among end users and tax return preparers and financial planners, frankly, around the solo 401k. And so I think this has been missed from time to time. I will say on this form, there's a revenue procedure talked about in the book where it says, look, I missed this deadline. It's generally 7 months after year end, and I just didn't file this 5500. Here, IRS, here's the here's the form, and you could get most of the penalty abated. I believe it's $500 you might still owe as a penalty for missing the filing. So, I think. A lot of my audience for this book is emerging solopreneurs, folks who are making that W-2 to solopreneurship transition. But yeah, maybe you've had a solo 401k and some of this stuff is news to you, or maybe some of the tax planning is news to you. And that's part of the audience I wrote the book for too. But there are ways to remediate when, hey, there's some missed filings. That's absolutely possible.
Can you just touch on the filing penalties are absolutely egregious. And could bankrupt you. They're that severe, and I don't mean that to like sensationalize it. I forget the exact math, but do you recall, like for every year?
I think it's something like $250 a day or something.
So
it's
per
ridiculous.
year, yeah, that can add up fast. You miss these filings for a few years, it's hundreds of thousands of dollars you can be on the hook for. Now, hopefully, the IRS after the fact, especially if you're a solo, you're small, you can prove you didn't really know what you were doing. Not that that's an excuse, I guess, but I like to think they'll grant you exception after the fact. What you mentioned is there is that forgiveness procedure where I think you have to cut the IRS off first and spot your mistake before they do. Once they spot it, I don't quite know how that works. They may have got you already at that point, but
yeah, I mean, I do think the IRS would want to at least think about how a court might interpret certain action. And as the enforcement agency, they have, think about like the speed limit, right? Does a cop pull you over at 66 miles an hour at a 65 highway, right? So there can be ways to remediate failures here. And I think, in terms of, the cop has discretion, right? I think the IRS at least has some discretion here in terms of how they enforce this stuff. So look, it's not a path I've really been down with clients, right? I focus a lot more on the planning aspects of the solo 401k in the book, other than the remediation. And then part of the reason you write the book is so that there's less remediation in the world, right? That people get out in front of this, and hopefully we have less remedial action needed in the future.
Yeah. We have a couple questions about Roths. Definitely want to get to those, but before that, there was one we chatted about briefly before we went live. So the question is, I had a solo 401k and closed it, but want to open one again. Do I need a new tax number, EIN, from the IRS, or can the old one be used? It's for the same consulting side business as the first solo 401k was used for.
Yeah, so that's an interesting question, right? And we talked about, right, so the business itself should still have the same EIN. So that doesn't change at all. The question is, does the new plan need a new EIN? And, so what I think would be interesting here is, my initial take, and this is just my initial take, is it's a new plan. It should have a new EIN. I would not be shocked, though, if somebody in that sort of situation went to the IRS website, applied for that second EIN for the plan, and they say, we issued you an EIN, use this one, right? So you might get an automated response in the mail from the IRS. My initial read on that, and I haven't come across that situation, my initial read on that would be, I would apply for a second EIN and then see what the IRS does with that. Their website might choke on it and say, you have to actually fax this thing over, right? They may say, you already have an EIN or you can't use this website. So you actually have to use the fax way. It's or mail. That's a possibility, I believe, as well. And then see what the IRS comes back with. They may come back with, we issued you this EIN in 2015. Please use it. Right.
Right. Okay.
So
now I actually, the confessional here. So I have a solo 401k for my own business. I'm a solopreneur. I have an EIN for my business, even though it's all passed through to me personally. So everything's up to snuff so far. When I started my solo 401k, the plan document, I used the EIN of my business. When I then opened, so the plan was established, I did not yet, at least, got a separate EIN for the plan itself. Now, just backtracking, I know you said it's good practice. Paraphrase, can't hurt to have it. Is that necessary, or you just think it's sort of good belts and suspenders to do?
Yeah. So to my mind, it's more the latter. So as a plan, I think technically it needs an EIN. What are the downside consequences? Not a whole heck of a lot, if any. And in fact, to my knowledge, the 5500 EZ doesn't even ask for the EIN. It only asks for the sponsor's EIN. So sole proprietorship, S corporation. Where I've seen it needed is in something called the voluntary compliance process. So I have seen that. So one of the ways where, hey, we had screw ups in our solo 401k, over contributions, whatever it is. And so now IRS, we're going to you affirmatively asking you to forgive us and give us remedial, remedies in terms of fixing this thing up. In that context, the IRS asked for an EIN for the plan. And all it meant, though, was, all right, client goes on to the portal, the IRS portal, and grabs, just gets one then. And then they just use it. So it wasn't that big a deal. When you're writing a book, you try to dot an I and cross a T. But yeah, I don't lose too much sleep over, hey, I've got a solo 401k and I never got that second EIN. I think technically it's required. I'm not here to say don't do it. Absolutely not, right? I would dot an I and cross a T. But the one experience where I saw it where, it was needed, but it wasn't there, the client was just able to go grab one.
Right.
So I don't think there's that much downside if for whatever reason that I didn't get dotted.
Right. You can dot that I when you cross that bridge, it sounds
yes.
like. Okay. That's not specific advice, though, just to be clear.
Yeah, I mean, this is, part of this is on some of these procedural issues, you got to remember a few things. One, the solo 401k has not come to the prominence I myself believe it should have. I did a whole video on the history of the solo 401k. The SEP IRA seems to be stubbornly popular, right? Not that the SEP IRA is necessarily a bad thing. I just think the solo 401k for most solopreneurs is better, right? So you got to remember, so there's that. And then you got to remember too, a lot of the IRS rules in all this regard are not written for solo 401ks.
Right.
They're written for Apple Computer's 401k, right? They're written for Google's 401k. And so now we got to apply these huge plan rules. They got all these anti-discrimination concerns where the executives are getting a ton in the 401k and the line workers aren't, right? There's all this authority out there, these, revenue procedures that are over 100 pages. And their real focus is the large employer 401k. But, oh, by the way, they apply to the solo 401k. So it's this weird, there's a little bit of weirdness out there in terms of, we've got some deficiencies maybe in a solo 401k. Now we got to go to these authorities that really apply to the large 401ks, totally different concerns. And so my hope is the IRS sort of streamline some of that stuff. Who knows what's going to happen in the future there. There's actually a helpful proposal in terms of IRAs and resolution where the Congress in the Secure 2.0 Act said, how you have the large employer resolutions, things like the Voluntary Compliance Program, please apply that to the IRAs as well. And so I hope maybe as part of that drive, they say, solo 401ks are different. So maybe we come up with their own resolution plan for them. So, these things are out there. And part of the reason you write the book is, hey, maybe if we get things right on the front end, we don't have to worry about uncertainties here. I will say the one time I was working with a client on a voluntary compliance program, the IRS is busy. And so it takes a while. But the person I worked with at the IRS was pretty reasonable. Once you explain it to them in language they understand, if that makes sense.
Okay. And quick sidebar, but going back to like the late filing penalties and stuff. So the solo 401k is a little bit of an offshoot from the larger 401k, multiple employers, the Apple plan, if you will. Those have super strict oversight and protections to benefit the employees under something called the RISA, right? Employee Retirement Income Security Act, where the plan administrators needs to act in the best interest of the clients, the participants. And so there's record keeping and disclosure requirements around that. Hence, the fees should be steep if the plan administrator is messing around and not doing what they're supposed to do. So just thought about this. Is that possibly the reason why those severe penalties from the real 401k plans have trickled down to some extent and apply to solo plans, even though they're not quite that, they're not covered by RISA, right? Solo plans.
So Andy, my read on it is the IRS certainly has some concerns around some more highly structured transactions. There's something called rollovers as business startups, ROBS transactions, which actually do impact solo 401ks. So this is, hey, I was working for a large employer and I got a big old 401k over there. What I could in theory do is a self-directed solo 401k where what we're doing is we're taking that old 401k and we're putting in a solo 401k, and now we're funding a business venture. And that's not really what 401ks are for. They're more for retirement savings versus funding one's own business venture. It's theoretically possible, and I think that might be driving some of it. The IRS did a memo in 2008. It's on the website. It's on the internet. It's a PDF. I linked to it, and there's a URL, I believe, in the book for it, where the IRS talks about these transactions. They don't only apply to solo 401ks, but they certainly can. And they're more likely to apply to a solo 401k than maybe to a small employer. And the IRS goes through some of their concerns. So I wonder if that drove some of these penalties as well. But that said, like I said, I didn't say this, but I've never seen that penalty enforced to its fullest degree. That said, I focus much more on planning than on, I've done some remediation work, but not very much at all. I'm, a financial planner, so that's not really what I do. So, it's out there. And this is the sort of thing, if you ever run into a problem with your solo 401k, you're going to want to hire a professional for two reasons. One, to remediate, right? Is there some remedial path we have to go down? And two, to make sure it doesn't happen again, right? If we made a mistake once, and we're all fallible, right? If we made a mistake once, we just want to make sure we don't make that same mistake again.
Yeah, got it. Let's get back a couple other questions, both loosely similar to different people. Roths. Can you convert a solo 401k to a Roth, I guess, either within that 401k or outside? And the other one, also about Roths. So let's, I don't know, talk about that. How do Roths work with this?
First, you'd want to see, does the plan allow an in-plan conversion from traditional to Roths? I suspect most plans don't, because that's another bell and whistle. I don't know that for a fact, though. So, and then the other thing too is, if you're making self-employment income, that may not be the time to do an in-plan conversion from a traditional to a Roth, right? Because your incomes are already so high because, hey, I'm making all the self-employment income. That might be the time to be focused on deducting contributions. So then you get to this question of, well, wait a minute, now I'm retired, Sean, and now my income is artificially low. Is this a good time for Roth conversions? And educationally speaking, right, not advice for any particular person, is oftentimes that is a great time to do Roth conversions. But what happens when I retire with my solo 401k? Generally speaking, what the IRS has said about this, and there's a lot of fuzziness here, but when you retire, you're no longer an employer. So you can't sponsor the solo 401k. So you, generally speaking, at that point need to roll it. Best practice is a so-called direct trustee to trustee transfer. So roll it from the solo 401k to a traditional IRA. And with an S corporation, it's nice because it's like, look, I was in an S corporation, I'm not working anymore, I liquidate that thing. Part of your liquidation checklist should be rolling over the solo 401k. It gets a little more squirrely when we're self-employed. And it's like, well, I might pick up another consulting assignment, right? Have I really shut down this trade or business? That gets a lot more squirrely. I think the IRS is going to be a little more lenient, I would hope, because that's a subjective determination. That's not black letter. Now, if I just go from $1 million of revenue to zero and I'm committed to zero, then yes, I'm out of this trader business. I should roll over my solo 401k. So that said, though, once the solo 401k is in the traditional IRA, then you just go to your brokerage platform and it's easy. The Roth conversion process is easy. You usually get that pop-up window. This is a taxable transaction. Are you sure you want to do this? And yeah, if you're doing good affirmative tax planning and it makes sense in your circumstances, then yes. And you just understand, that creates taxable income.
Yeah. So it sounds like, and this is my experience as well, I've come across it once, maybe twice, where you have a solo 401k for consulting, whatever your business is, you quote unquote retire, you in good faith expect to not work for yourself anymore. You can't really keep the plan open, right? The plan in effect has to terminate because that employer kind of ceases to exist.
Yep.
So I think you're forced to roll it over, terminate the plan.
Yep. Yeah.
With that, now the termination triggers the requirement to file a 5500 EZ.
That's right.
Okay. That's a big one. I think a lot of people don't know.
Yeah. So when you close out the solo 401k, you always file this form 5500 EZ. I think where folks struggle is, well, I'm sort of downshifting my business, but maybe I'm not fully retired. Or when is that? Or I'm still thinking, I took a month off, but I might, that doesn't necessarily, close your trader business, right? And, the IRS, there's no regulation I can point to you to say that says within 90 days of the termination of this business, this must be rolled into a traditional IRA, right? So I think there's I think the way the IRS hopefully looks at it, I think the way the financial institutions look at it, and the way a court theoretically would look at it, I hope, would be sort of a rule of reasonableness, right? We're not looking to disqualify plans because that's a very deleterious effect, right? So if a plan gets disqualified, all the money in the plan becomes taxable income if it's traditional, 401k to the plan participant immediately. That's sort of that's like the death penalty for running a stop sign, right? We don't want to do that. So I think what I would hope when the IRS is enforcing this, even if they notice something, they say, hey, your Schedule C income dropped like a rock and it doesn't seem like you're making any Schedule C this year. Maybe what they say is, okay, now is the time. Go ahead and do it now, right? We'll come in and re-examine plan qualification if you don't do this within a reasonable amount of time of a notice from the IRS that, hey, maybe you need to do this. The other thing too is the plan, the financial institution is going to reach out if you don't make contributions for a while, right? They're going to say, they're not going to say, oh, you have to max it out every year. That's not the requirement. But if you're not making contributions for years, they're probably going to reach out and say, hey, do you still have that trader business? Now might be the time to roll that into a traditional IRA.
Okay. And speaking of the custodian, important to know, my understanding is they basically wash their hands of responsibility for this and guidance and advice on this. If you set the plan up incorrectly, if you use your social security number instead of an EIN, they're not going to stop you generally. I've seen it happen, at least let me put it that way. So just because Fidelity or Vanguard or Schwab or whomever will let you open an account as you fill the forms out, they're not blessing it explicitly or implicitly. They're not giving you guidance. It's completely on you and or anyone else you choose to use to help you with it, right? So buyer beware.
Yes. A couple of points on that, Andy. That's a great point. One thing to keep in mind is the custodian, Vanguard, Fidelity, Schwab, E-Trade, whoever it is, they don't validate that you have a job when you make a $6,000 Roth IRA contribution, right? They're taking your word for it. You have earned income, right? You don't have to have earned income, right? So even in that regard, they're not on the hook. And here's another thing about two things about working with the plan provider. One, they are not your tax professional. They are not your lawyer, right? So you just have to keep that in mind. You may need other professional consultations. And two, it never hurt to call the plan provider on day one or on Wednesday and say, hey, I'm having this issue. What's your take, right? You talk to the representative, you take some notes, take their name down. Great. Then on Friday, you get up and you make another phone call to the exact same plan provider and you say, hey, I'm having this issue. What's your take? You write down the notes, you take down the name, and then you compare Wednesday's notes and Friday's notes. And not that that's professional advice to you, but it would be good to see if those things agree with each other. And if they do, the smell test starts to get passed. If they don't, Now you need to resolve that, right? So there's
Yeah.
nothing wrong with reaching out to your plan provider more than once to revalidate these things. I think, here's the thing you got to keep in mind with all the plan. I'm not here to criticize any of the plan providers. Roth IRAs, right? How many Roth IRAs do you think Vanguard, Fidelity, Schwab deal with every day, right? And that's coming in every day, twice on Sunday, right? They're used to that. Solo 401k, is much newer. As a practical matter, it didn't even really exist from a planning perspective until 2002 for most people. And, I think the plans, the providers, even after 2002 were like, SEP IRA, SEP IRA, SEP IRA. The interest is picking up. But I think you do have to keep that in mind that, not every representative at every plan provider knows everything about the solo 401k.
Right. Now, and when you say plan provider, are you referring to custodian like Fidelity?
Yeah, custodians,
Okay, got it.
Financial institutions. Yeah, that terminology, the Vanguards, the Fidelities, the Schwabs, the E-Trades. And there are plenty of others.
Now just for those interested who are going down this path of solo 401k, like I opened one 2 years ago for myself. And I mean, I'm in the business. My client's custody at TD or Schwab, but because my wife is separately in the financial services business, we are required to have our accounts at her firm, which custodies at Fidelity. So my solo 401k is custodied at Fidelity. When I open this plan, they have the plan document, and there's just a prototype. I think it came from a company called PenServe. So like Fidelity doesn't even create their own solo 401k prototype document, which was a few dozen pages. They just use a third party off the shelf one. I fill in the blanks. My year end is December 31st. My plan name is XYZ, whatever. So it was completely on me. They made it clear we are not giving you any guidance on how to fill this thing out. So I took the template from PenServe that they gave me, filled it out, sent it to them, filled out the application to open the actual investment account associated with the plan at Fidelity, which was fairly straightforward. But anyway, so just terminology wise, like plan provider, plan administrator, whatever, you have the custodian who houses the investment account, and the plan document may or may not come from some party you never heard of. In my case, it's PenServe, right? They're not my administrator. That's just the one who created this prototype template document that I opted to use for my account. Anyway.
Yeah, no, that's a great point, Andy.
Okay. Let's see. I think so that about covers it for the Roth aspect. And yes, you can have a Roth for solo 401k. Like I do, for example. Fidelity allows it. I know TD doesn't. Schwab does not, I don't think. I'm not sure about, I think Vanguard does.
Vanguard certainly allows it, yeah.
Okay. So if you want the ability to contribute to a Roth within your solo 401k, you have to find a custodian that allows it. As far as doing in-plan conversions, like you said, I haven't come across it. Sounds like you haven't either. A plan,
I'm not
document
seeing
that allows it. Okay.
Yeah, I mean, one of the things about the pre-approved IRS plans where you're mostly investing in diversified mutual funds is they don't have too many of the bells and whistles because they're trying to make things simple for everybody. Their compliance costs, the end user experience, they're trying to make it as simple as possible.
Yeah.
And so they tend not to have these, like loans, for example. Most of the pre-approved plans don't allow solo 401k loans. I myself am not a big fan of solo 401k loans. So I think that's one of those like, oh, I'd rather have the pre-approved plan, keep it much more simple, and I can't take a loan for my solo 401k. I'm okay with that.
Yeah. Fair enough. All right, coming up to the top of the hour. We answered a handful of questions we got already. Other thoughts, comments, parting words of wisdom?
No, I think this is one of those things where there's a lot of opportunity out there. Not enough solopreneurs know about it. And so I hope that folks who are self-employed themselves or who advise those who are self-employed get more education about this. I think this is where the workforce is going, right? Folks are realizing they don't have to work for one W-2 employer for 20 or 30 years. So if our clients are going that way, if this could be great for advisors themselves, why not get some education about this? I'd be honored if you use my book as one of those resources, but even if you don't, I think people need to get educated about this. And we're not splitting atoms here. It has some nuances, but there's a lot of tax saving opportunity here.
Now, do you, someone has a business, they're not very financially inclined, nor do they want to get involved in setting up their own plan, whatever. What are the options? If they just randomly call up Fidelity or Vanguard what's going to happen versus are there third-party folks that specialize in stuff like this to do the work for you more or less?
Yeah, that's an interesting question, Andy. And I think what you have to do is think about the financial planning world and the tax return preparer world. And my experience is this is a little bit of a gap in terms of knowledge bases because, we have W-2 workers who are our clients, right? And they don't have a solo 401k. Why do I need to know about that? And if you think about tax return preparers, a lot of them are focused on April 15th, October 15th, getting those tax returns done because that's where the fees have come in. Right. And the planning is tougher to integrate into the business. And a lot of financial planners, look, financial planning has all sorts of disciplines, investment allocation, insurance planning, estate planning, right? There's all sorts of different disciplines. And so there aren't that many folks who specifically specialize in this. Look, I can't tell you that it's none. There's certain financial planners who I think have more of an aptitude. They're just sort of more interested in, say, self-employment tax planning than they might be in insurance planning, right? So that's sort of out there as well. So I think you just, whenever you're hiring a professional, tax return preparer, financial planner, whoever it is, interview some people, right? We have Zoom, we have Google Meetings, right? So interview 2, 3, 4, 5 people. Say, hey, I'm self-employed. What's your experience around this? And, it's both experience and knowledge, but it's also fit and feel, right? Yeah. You want to work with a planner that you have or a professional that you have a good fit and feel with. And for different people that, there's no perfect planner or professional for everybody. And, clients can have good experience with multiple different providers. It's just, I would always go with, I look to interview multiple people in this regard.
Right. And see who gives you the best feeling. And sounds like they know what they're talking about the most. So,
yep.
Yeah, cool. All right. Great. Well, thank you for everyone again. This is Sean's book. So what I'll do is after this video replay is saved up to YouTube, I'll make a post in the group sharing the video replay and a link to, I guess, the Amazon site for your book. Is that okay, Sean? The Amazon link? Is that the best?
That's great. Thanks so much, Andy.
For those who are interested. All right. That's it. Sean, stick around a little bit. Otherwise, thank you, everyone. It's been a pleasure.